Well, let's have a check-in on how fund managers are looking at markets around the world. Chad Slater is the Co-Chief Investment Officer at Morphic Asset Management, and he joins us now. Chad, good to speak to you.
Good afternoon, Helen.
Yeah, now let's talk about what are you seeing are the real sort of standout pieces of data that are really driving the way markets are thinking, but also the way fund managers are thinking?
Yeah, it's a good question, Helen. I think sometimes us in markets forget that financial markets interpret the real world data out there, and the real world data, as you sort of noted there, has been absolutely phenomenal in the last couple of weeks. Your article just before touched on the auto sales, and we had the US ISM survey. So this is a survey of all purchasing managers inside manufacturing businesses, and that data came out on Tuesday night, and that was the highest data in 13 years. So that was even higher than what it was in the rebound of 2009, 2010.
Yeah.
So you're seeing really strong US data.
Quite extraordinary, wasn't it? It was what, at 60.8 last month?
Yeah, so that was ahead of expectations. Now, the only caveat I would put there is clearly, and you alluded to it with the autos, there's some demand pull forward coming with the hurricanes. But yeah, it's an incredible number. Like that says GDP is growing at 3% plus. Now, it's probably a little bit on the high side, overstating it, but nonetheless, sort of tells you which direction the economy is running in, which is faster rather than slower.
Yeah, so how does that then play into the way fund managers think?
Yeah, so look, if we look out, say maybe 3 to 6 months from now, firstly, let's remember seasonality. It exists in markets. So we are in the best 3 months of the year. On average, markets rise their most over the coming 3 months. Now, there's many reasons put forward for that, but the reality is it tends to happen. So if we look at this good data there, and good manufacturing data tends to correlate with better earnings and better confidence, we'd have to say that it looks like seasonality is going to play out. So our view at this moment in time is that markets will actually go higher, actually maybe even a fair bit higher into year end. We'd say you should be bullishly positioned, you should be long markets here.
All right, so now can you extrapolate out the US ISM to a global version?
Yeah, JP Morgan put together a composite of all the economies of the world's PMIs, and it didn't quite go as high as the US one did for the reasons I spoke about on the hurricane, but nonetheless it is its highest point it's been in 4 years. So there's only really one area that slowed down last month, and China had a small slowdown, but Europe as a whole was excellent. And if we come back to Australia, Australian numbers are very good as well. So this is really a global phenomenon. We haven't seen synchronised global growth like this in the better part of a decade now.
All right, so just come back locally. I mean, the rate of job creation here really has been pretty extraordinary, hasn't it?
Yeah, I think sometimes people forget that 30 or 40,000 jobs here, which is what we're running at the moment. So Australia over the last... Sorry, what's that, Helen?
A month?
Yeah, so 30 to 40,000 jobs per month is what the current run rate of job creation in Australia is.
Yeah.
So if you took that and gave that a US-sized economy number, that's almost 400,000 jobs a month. To give you an idea, the US currently runs at about 180,000 jobs a month. So the Australian economy, workers may not feel it at this point in time with the wages. There's just no wage growth, but nonetheless, the underlying economy is creating a truckload of jobs at the moment.
All right, so, I mean, you know, you say so it's all systems go and you're sounding very optimistic. Why isn't the Australian market in general more optimistic? Why are equities stuck in this range? Why do consumers seem to be, you know, less optimistic than the data would suggest we should be?
Yeah, there's two conundrums there. One of them is sort of explainable, which is the Australian stock market's been one of the world's worst performers this year. Every other market in the world is up quite a lot in double digits some cases, and Australia's pretty much flat. And partially it's a construct. Banks and resources account for over 65–70% of the market. So banks, look, I won't go into too much detail here, but it's not a great environment for banks to grow their loan book at the moment. And they actually don't want to grow their loan book, and they're coming under regulatory pressure.
Yeah.
And resources, well, last year was a great year for resources, but the Aussie dollar, you also got to keep in mind, has rallied almost 15% this year. Yeah. So whilst they may earn more in US dollars, in Australia dollar terms, that's offsetting a lot of it. So there's that one part of it. And the other part of it is why do people not feel more upbeat? And this is a huge conundrum here, because if you look at like some of the NAB survey data, businesses are very upbeat, and they're translating into actions. They're hiring people. You can't be more real than that. But what they're not doing is giving anyone a pay increase. So I think that's sort of where you get this dichotomy between people who have seen no pay increase, yet businesses who are quite happy hiring more people. Generally what happens at this point is ultimately they use up spare capacity and you get your wage increases. Wage increases come last in the cycle normally.
lag along. And I guess that, you know, consumers have been happy to kind of pile into borrowing for houses over the past, 4 years, certainly in the city of Sydney. But they have been wary about other things. So the implications for equities into perhaps the year end?
Look, Helen, we're pretty optimistic. You know, all this with the ISM and this survey data, etc., and things like that. Look, late 2018 might be a problem because you might have rate hikes coming through in early 2018 around the world. But until year end, we're generally quite optimistic. We see markets in particular, North Asia like Japan, Korea, Hong Kong continuing to perform well. The US dollar will probably stabilise here and stay long risk. The rates might go up a little bit in the belly of the curve, so the 3 to 5 year part. But we can't see 10 years going up too much. There's just no inflation at the moment. So generally it's a pretty good environment to be an equity investor.
All right, Chad Slater, Co-Investment Manager at Morphic Asset Management. Good to speak to you, Chad. Thank you.
Cheers. Thanks, Helen.